Good afternoon, everyone. Myself, C. Raj Chawla, welcome you all in this today webinar, and also happy Deepavali to you and your family. So today we are holding a webinar on decoding Indian Accounting Standard 33 earning per share and Ind AS 23 borrowing cost. And today we have with us our two young and dynamic faculty, CA Narayan Chaturvedi ji and CA Manish Goyal ji. So first we will listen to Narayan Chaturvedi ji, and today we will cover the following topics: scope and applicability, key concept and definition, learn EPS computation and presentation requirement in DS 33, understand recognition, measurement and disclosure of borrowing cost under Ind AS 23. Now I request Mr. Satyam Gupta to please introduce our guest faculty for today. Over to Satyam.
Thank you so much for giving me opportunity today's session. Good afternoon, everyone. A very warm welcome to all our participants joining us today webinar. We truly appreciate your time and enthusiasm to be part of this insightful session. We are honored to have two distinguished speakers with us today, CA Manish Goyal sir and CA Narayan Chaturvedi sir, both highly respected professionals in their fields. Our first speaker, CA Manish Goyal sir, a highly experienced finance professional with over 25 years of leadership experience as finance director, CFO, and CAO in some of the world's leading multinational companies. He has worked across diverse industries from automobile to pharmaceuticals, electricals to EPC, and recently retired as group director, finance from a multi-brand auto dealership group with a turnover exceeding 1,000 crores. He now serves as a practicing chartered accountant and senior faculty at ICAI and Sri Ram College of Commerce, Delhi University. CA Manish Goyal sir with us today to share his valuable insight and rich experience on Ind AS 33. Our second speaker, CA Narayan Chaturvedi sir, is the founder of Yes Vistar Advisors and Yan Chaturvedi and Company. He is an renowned audit and advisory expert, corporate trainer, and business coach with rich experience working with Fortune 500 clients, big four firms. He is known for his expertise in finance, internal controls, and data analytics, and for inspiring professionals across India through seminars and webinars. CN Narayan Chaturvedi sir with us today to share his valuable insight and rich experience on Ind AS 23. We are privileged to have both our experts with us today. Let's begin this session by welcome our first speaker, CA Manish Goyal sir. Over to you.
Hello.
Yes, Narayan ji, please continue.
Okay. First of all, thank you so much, Raj Chawla sir, for giving me this opportunity to discuss my views on the Indian Accounting Standard 23, which is the borrowing cost. And thank you, Satyam, for giving a precise background of my previous experience and to a little knowledge that I have so far on the areas that I have served. So thank you very much for all this platform. I'll start my discussion. I'll start my pointers first. Before that, I would like to ask the participants if you have any thoughts around the borrowing cost and anything that you would like me to express my views in particular or related to any particular topic that is there in your mind. I'll take a pause and see if there's any uh, response from your end. And I would really request to keep this conversation as a discussion, not a one-sided communication from my end only. So I would really urge everyone to be participative and have and ask as many questions as possible from your end. I would really love to answer those questions. Okay. Before I start my session, I'll just present my screen. So today we are going to Today we are going to discuss the Indian Accounting Standards 23, borrowing cost and the related provisions. First, I'll just set up a base related to the content that we are going to cover. First, we are going to discuss the scope of the borrowing cost. What does the borrowing cost actually means? What are its components? And the other one would be the recognition of the borrowing cost. Later on, then the types of borrowing. We have two types of borrowing, be it specific borrowing and then uh, the general borrowing. Uh, Next would be stages of capitalization and India's versus AS16. The earlier we used to have accounting standard 16 related to the borrowing cost. After incorporation of the Ind AS, which is the converged IFRS 23, so we are going to discuss the differences between these two, and then we'll discuss around the queries that you may be having on all these aspects. Give me a moment. I'm not able to finish the slide. Sorry, sharing my screen again. Just bear with me for a moment. Yeah. So this is a content that we are going to discuss, as I just talked about. First, I will discuss around the borrowing cost. What does that borrowing cost actually means? So borrowing costs are the costs that are directly attributable to the acquisition, construction, or production of a qualifying asset. So here we are stressing upon one of the most important aspects, which is the qualifying asset. Not every cost or the direct cost which should be related to any of the asset will be considered as a borrowing cost. There are two aspects. The cost should be directly attributable and it should relatable to the qualifying asset. And when we talked about a qualifying asset, what does that qualifying asset means? A qualifying asset is an asset that takes necessarily that necessarily takes a substantial period of time to get ready for its intended use or sale. So not again every asset would be a qualifying asset. The asset that will take substantial period of time. Again, if we talked about some of the aspects, whether the financial asset or inventories will be considered as a part of qualifying asset, the answer would be no. Why? Because these are the assets that are ready for their intended use when they are acquired, and that will not take any substantial part. Usually, we are considering interest and other costs as a borrowing cost, and those costs are to be incurred by an entity in connection with the borrowing of fund. If there is not going to be a borrowing, then we will not talk about the borrowing cost. That will only arise when we have the borrowing of any funds related to that, related to acquisition and construction of a qualifying asset. And how we would conclude that one, whether this interest and other costs will be part of the borrowing of the fund. So first, we'll conclude whether this interest and other costs are directly attributable or not. And if interest expense that we will calculate using the effective interest method will fall under the purview of this Ind AS 23. But if that interest, how we will calculate that interest? So there is a specific mechanism related to the Ind AS, related to the calculation of effective interest rate, which is a part of the Ind AS 109, wherein financial instrument. So that talks about the we have a separate instrument which, because there are certain aspects, because we are talking about the effective interest rate method, not just the interest. We all know it could be a fixed rate, variable cost, and but there are other aspects of that as well when we are considering whether these are, if let's take an example. If we have taken a borrowed funds in a foreign currency, in a foreign currency other than the Indian currency, then not just the interest portion will be there. Obviously, if it's a borrowed fund, interest has to be there, whether it's fixed or variable, and it has to get changed because of the changes in the fluctuation of the foreign currency that we are dealing in. So that change of fluctuation in the foreign currency would somehow impact our entire cost of that borrowed amount. So there in the financial instrument Ind AS 109, we will also take into consideration interest and other costs, and that will include the fluctuation change. And with that amount, we will calculate the effective interest rate. So we'll not consider the fixed or a variable portion as just taken bluntly with respect to the agreement that we have with the financial institution from where we have taken a loan. But we'll take into consideration the effective interest rate we'll calculate. There is a specific mechanism and the calculation procedure that we need to, steps that we need to follow. I'll take a pause and to see whether we have any question over here. Okay, I'll take silence as no. So next, we'll talk about recognition of the borrowing cost. So there are, as I mentioned, there are two aspects, whether we can either capitalize the borrowing cost or either expense it out. When we are going to capitalize, every expenditure related to the borrowing cost that directly attributable to the acquisition, construction, and production of a qualifying asset will be capitalized. So that's one thing. If it is not directly attributable or any other cost, then it has to be expensed out in a year wherein that expenditure has been incurred. So there are only two aspects, whether to capitalize it or to expense it out. And when we talk about capitalization, the amount will get added to the amount of the qualifying asset. Here, two important aspects that we need to consider. First, borrowing cost that an entity capitalized during the period should not exceed the amount of borrowing cost. Obviously, when we are incurring a borrowing, obviously when we are borrowing a fund and we are making an expenditure in terms of its interest and other costs that we are considering them as a borrowing cost, that capitalization cannot exceed the expenditure that we have incurred. We cannot take any other expenditure and just capitalize just for the sake of increasing the value of that qualifying asset. Next thing, we need to confirm that borrowing of that amount which has been capitalized during the year, and that has to be shown in the financial statement as a disclosure. The two things that we need to disclose in the financial statement: first, the capitalization amount that we are capitalizing this amount to the acquisition and construction of a qualifying asset, and the capitalization rate. And where do we use that capitalization rate? When we are going to have the two types of borrowing, either specific or general. So, specific borrowing we are considering when we have specifically taken an amount or a borrowed fund for the acquisition construction of a qualifying asset for a, like, for that specific borrowing should be there. Let's take an example. If I'm a pharma industry and we are making a plant in the outskirts of the Himachal Pradesh and we are making an expenditure there. So the expenditure, the funds that I have acquired to manufacture or to make the plant that operational over there, I need to make certain expenditure. And that expenditure I am making is out of the specific fund that I have borrowed for that particular purpose, not the general fund. So whatever the borrowing cost that I will have in order to have that arrive at the particular on that amount that I have borrowed will get capitalized. However, there is one aspect that we need to see, that if there is some amount that remains idle, let's take an example, I have borrowed 100 CR and the expenditure is going to be made in a phased manner. Like, let's take an example of 15 days or maybe a month or maybe a quarter. So what will I do? I will take that and I will take the remaining amount which is not required at present. I will consider that as an idle fund. Either I can invest that amount for the time being. If I am able to earn the amount out of or earn the return out of that amount, I can take net of that cost as a borrowing cost. Am I clear over here? Okay. I'll take the silence as yes. Next would be a general capitalization rate. Let's take an example. If any organization has borrowed has taken a term loan or a OD limit for making an expenditure or for a working capital loan that they are going to use in terms of running their operational expenses or daily operations of that organization. However, if let's take an example, if I take some amount of that loan to acquire a particular asset, in order to calculate the amount attributable of the borrowing cost to particular asset, I need to calculate the weighted average cost. And what that weighted average cost will be, like, there are multiple instances wherein those those borrowings can be for a multiple purpose, general purpose, or like as an organization as a whole. So taking into consideration all the liabilities and its utilization, corresponding incurring of the borrowing cost, I will take the uh, borrowing cost for that particular for not that particular purpose, but for a general purpose, and then I will calculate a capitalization rate, taking into weighted average of that borrowing, considering the weights. Uh, I hope I'm clear over here.
Yes, sir.
Okay. All right. So there are three stages of capitalization, as we mentioned in our content, that there are three stages of capitalization. First one is the commencement of capitalization. So when we would consider that a capitalization has been commenced, first step we need to incur the expenditure. Next, incur the borrowing cost, and then undertake activities that are necessary to prepare the asset for its intended use or sale. So let's take an example. I have taken a fund to install the pharmaceutical plant in the outskirts of Himachal Pradesh, and and then I have borrowed 100 crore of the amount for expenditure for borrowing cost that is relatable to that loan. I would say, uh, be it interest expense, processing fee, or any legal fees in order to draft the agreement. There are certain legal type of expenditure that needs to incur. So those are the expenditure that are directly relatable to that particular uh, uh, for that particular purpose. So the expenditure that I'm going to incur, that will qualify for the capitalization. Guys, yes, no. uh, Satyam, are you there? If
Yes,
you can
sir.
help me
Yes,
with
yes.
the responses. Okay.
Okay, sir.
So are you with me on this, that expenditure that we are incurring on that as expenditure that we are incurring on to borrow that amount will form part of our capitalization, will form part of our borrowing cost, right?
Yes, sir.
Okay. And then after borrowing the amount, I need to make an expenditure. So what purpose, for what purpose I have borrowed that amount? If let's take an example, I have borrowed that particular amount to install the machinery or importing the machinery from anywhere outside the country. So whether I am making that investment to acquire that machinery or not. So I need to consider two aspects here. First, borrowed the fund, then incurring the expenditure, because right away whenever we borrow the fund, our interest or the borrowing cost will get incurred or recur, and then once we make the investment, that is, we have utilized that borrowed fund in order to acquire that asset. And if it requires us to make certain changes in for its intended use, that not just importing the particular plant would suffice for the capitalization purpose. We need to have that plant set up in India into our premises of the factory. We need to make certain changes in terms of infrastructure to prepare the base for it. To set aside whatever is specifically required for that, in order to have that plant making to help that plant to help that plant for its intended use or sale. So after meeting all these three criteria, my commencement of capitalization will get started. So whatever the interest or the expenditure or the borrowing cost that we will incur before these three steps will not capitalize, but post these things will get capitalized. So what we will do for the expenditure that is going to incur before borrowing this amount or before these three steps? Any thoughts, anyone? Okay, I'll take the silence as no. Then okay, so again that amount will not get capitalized. That will expensed out when that amount will get confirmed or incurred. Now, there are instances where there is a possibility that the capitalization should cease. What should be the those criteria? Let's take an example that we again, as I mentioned in my previous example, that we are going to import certain plant from the from outside India. So there must be some sort of technological advancement which is not there in India, which requires us to have that particular particular asset, particular plant from outside India. However, because of certain geopolitical or governmental relations with other country, there is a possibility or there may be a chance wherein that those there may be in future that those restrictions may get into existence wherein we may not be able to capital or we may not be able to import for a particular period of time. I wouldn't say for every time, but for a limited period of time. If let's take an example for 2 to 3 months, if our import will get restricted for any particular reason, so during that period, because our capitalization will get seized, because that requires capitalization should cease when substantially all activity to in order to prepare the qualifying asset for intended use are complete. So that cessation period will get implement I would say implemented. Next would be the suspension of capitalization. If there is a possibility that we have thought in our project report when we borrowed the fund, if we have taken a fund, we have taken a borrowed money to plan to make an expenditure in such a way to have that amount or make to have that expenditure completed or that or to have that plant make that ready for use within a particular period of time. Let's take an example for 2 years, 2.5 years. What if in a scenario it gets extended? So obviously there may be a political again for any reason for geopolitical reason for internal instability within the state there could be a possibility of a strike or for any other reason that our expenditure which was supposed to be incurred during that time frame was not incurred or because of again because of certain reasons we have to ask the respective approval from the government or any particular agency to extend uh, our time frame wherein we could have import the plant. So in those scenarios our suspend our during extended period like for after extending the initial period from the initial estimated period to the next acquisition period, that will be considered as an extended period. So the expenditure that is going to incur during that period will not be considered as a as a as a part for the capitalization because that period in which it suspends the active development of a qualifying asset is suspended. So those two scenarios wherein we are not going to have the capitalization of the borrowing cost will be there in terms of making a qualifying asset. So that's a that's a basic rule for making an investment. I mean not investment, but for considering the borrowing cost attributable to a acquisition and construction of a qualifying asset. I'll take a pause here to ask if there is any question. Okay, so we are just entering the last almost the end of our pointers over here that we are going to discuss around the AS23 and AS16, the difference between these two. So any thought from any participant that you would have thought that in the AS23 is having certain parameters or certain provisions which are not there in AS16? Satyam, are you there?
Yes, sir.
Okay. So do we have any raise of hand or any response from anyone from the participants? Satyam, do we have? Uh, am I audible?
Yes, sir. You are audible, sir.
Okay. Okay. So I believe we don't have any raise of hand or any response from the participant till now, right?
Okay, sir.
Okay. So I'll move forward. So there are few differences between Index 23 and AS 16 that is related to the borrowing cost. So both standards have a provisions relating to capitalization of a borrowing cost, or if those parameters are not being met, then how we would expense out that borrowing cost. So first, we'll discuss around the specific exclusion. So in the definition, initially scope of this India's 23, we had discussed the borrowing cost directly attributable to the acquisition, construction, or production of a qualifying asset measured at a fair value. So there are few assets that those again for which we have borrowed fund, the expenditure is being incurred and they are taking substantial time, but their valuation is being done at a fair value, like for a biological asset. So there are kettles, there are industrial wherein few biological assets are being. So we have borrowed fund, we have taken expenditure. They are considered as part of our asset, but those are not form part of the earlier AS 16. But now they have also been included in the purview of the Ind AS 23. Next, specific exclusion. Again, the borrowing cost directly attributable to the acquisition, construction, or production of inventories that are manufactured or otherwise produced in large quantities on a repetitive basis. There is a specific exclusion from AS 23, from in AS 23, which was not there earlier in the AS 16. So both are not being covered by any of the provisions, but still there is a specific exclusion in AS 23. That's the only difference. We'll not consider that those whatever the cost that we will incur for a borrowing purpose, or we'll consider that as a borrowing cost related to these will get capitalized. The answer would be no, because these are specific exclusion in Ind AS 23. The next one is amortization of discounts or premiums relating to the borrowings. So again, there are amortization of discounts or premium. So when we borrowed funds, there are instances of taking a amortization of discounts or premium. So can anyone from the participant help me understand what is this amortization of discounts or premium relating to borrowing? When we have those instances of having that amortization of discounts or premium. Okay, I take the silence as no. So let me give you an example. There are specific projects or there are industries wherein certain organizations take money from the public in the form of either preferential capital or debentures or bonds. So in these scenarios, there are instances wherein the issue price would be less than the issue price would be less than the fair value of that particular script, I would say, script. So in that case, what we'll have either discount or premium, or again, it can be a vice versa situation wherein the issue price is more than the face value or the fair value of the script. So in both of these scenarios, there is a possibility that discount or premium of that on that acquisition of that borrowed amount will be there. Earlier, as per India's 16, there was a scenario of making the amortization or dealing with the amortization of those expenses or those costs related to the borrowings. But India's 23 does not talks about any specific provisions related to this amortization. So that's a catch over here. Next one related to amortization of ancillary costs incurred in connection with the arrangement of borrowings. Here we need to understand related cost incurred in connection with the arrangement of borrowing. So what does that mean? Arrangement of borrowings is related to the borrowing has not been incurred, but there is a possibility that arrangement of like I am going to or an organization is going to borrow the funds for a particular purpose. there are ancillary costs related to, like, let's take an example of feasibility study. There are attempts that have that feasibility studies have been made, legal expenditure has been made, or some sort of technical advisory that that organization may take in order to proceed before making before borrowing a fund. So those ancillary costs in order to borrow the fund, because those expenditure will be considered as a part of the actual cost once once we will finalize the borrowing. But ancillary costs are related to some sort of small commission expenditure related to traveling, or all these expenditure will be considered as ancillary cost, and amortization of those costs was not treated is not being considered for a in the AS23 purpose, but it was there in the AS16. Initially, we have discussed around the borrowing cost. When we talked about it, is the borrowing cost which is directly attributable to the acquisition, construction, or production of a qualifying asset. What does that mean for a qualifying asset which takes substantial period of time to get it ready for its intended use or for sale? But that substantial period of time in India 16 was earlier considered. Any example, anyone? What we were used to consider the substantial period of time in India 16? Okay, so it was usually 12 months. So whatever the amount or a borrowing cost that we are incurring for an asset to get it's ready for use, if the period for that of that asset is more than 12 months, we would consider that as a qualifying asset in general. But now this scenario is not here in India's 23. So substantial period of time is not specifically defined or not being considered. So we have to see what exactly is the meant of substantial period of time that we have to consider case by case. So what there are maybe asset that may take substantial period of time in terms of let's depending upon the business of the industry that we are into. So that case to case basis has to consider. I hope I'm making a sense over here. Satyam, do we have any question?
No, sir.
Okay.
Sir.
Next one is the treatment of Ind AS 29, financial reporting in hyperinflationary economies. So again, we talked about around the specific exclusion that we have. Initially, we talked about how do we calculate the effective interest rate in order to ascertain the borrowing cost or a borrowing cost for that acquisition or construction of or a production of a qualifying asset. So that treatment of India's 29 financial reporting in hyperinflation economies is there in the India's 23, but it was not there in the earlier AS 16, accounting standard 16. Disclosure requirement of capitalization rate. India's 23 specifically talks about two types of disclosure, as I mentioned earlier. First, the amount of borrowing cost that is being capitalized during the year that needs to get disclosed, and the capitalization rate. However, accounting standard 16 does not talks about any specific disclosure related to capitalization rate. When we started this discussion, I took the example of making an investment or making a borrowing in the foreign currency. So if there are instances we have borrowed funds in the foreign currency, there has to be they has to consider a changes in the forex rate with respect to Indian currency and the currency that in wherein we are making the payment. However, for the purpose of India's 23, in case of foreign currency borrowing, it specifically talks about functional currency, and accounting standard 16 talks about the local currency. Can I get any example from the participants that what does that functional currency and local currency is? Okay. Satyam, do we have any raise of hand?
No, sir.
Okay. So I'll explain. Local currency, let's take an example that there is an industry which is located in India and having a parent company in the America. So when we are going to show or see the borrowing cost in the of the amount borrowed in either in INR or in US dollar. So we'll consider local currency of the company wherein the principal office of that company is situated. And functional currency, if I talked about, if let's take an example that majority of the economic activities of that organization is taking into place in INR, that would be considered as their functional currency because majority of the functions of that company or an industry is taking place into INR. So that functional currency will be considered INR for in that particular instance. I hope I'm making sense over here. Okay, I take the silence as no. I mean, yes. So that was it from my end, team. Any question? The forum is open for any questions from the participants related to anything. If you have any query to ask, what does that borrowing cost? How do we how do we make the treatment in the financial statement?
No question, sir.
Okay. So here is my contact details. If anyone has any query in future, please do contact. Feel free to let me know
Thank you so much, sir.
anytime, any queries.
No, sir. No query.
Satyam, I'm done with my session.
How like partial money is well, sir?
Okay.
Hello, sir.
So yeah. So do we have Manish Goelji with us?
Money is well, sir. Are you here?
Yes, good evening to all.
Good evening, sir.
Am I audible?
Yes, sir.
Yes, yes. Okay, let me share my screen. Okay. Hello friends. This is CA Manish Goyal, and today I will take you through an interesting session with the India's 33 earning per share. Right. So welcome to all participants. So let's start. This is my brief faculty profile you may go through. Now, coming back to the Ind AS. Now, friends, you know that Ind AS, these standards, it's quite long. In 2015, right? The government MCA came with the notification and with the Ind AS version. Now, even in 10 years, you know that even after we read all these Ind AS multiple times, even after that, we feel little lack of confidence, isn't it so? Right. So that's what all these needs to attend the various webinars and classes are there. So today we will try to understand Ind AS 33 in such a way that there should not be any class after that, or there should not be any need to attend the webinar, at least on Ind AS 33. Correct? That's our objective. So please ask as many as questions you can ask, so that not anyone a single doubt of yours you should carry back home. Now, we have a little time, and so we'll just come to the thing. Now, the point is that number one, please ask as many as questions. Even then, whatever the points being discussed, if you have any issue, you can raise your hand or use the moderator and tell me, because it's a completely two-way communication. So you can ask then and there. By that, I'm enabling the chat box. Just give me a minute. Right. So the chat box is fully enabled. I'm writing hi. Yeah, you can ask your question on the chat box, right? And whatever question is left unanswered, that we will very well take up it up after the session is over. But I will try to answer all your questions. So let's enjoy the session. Now, friends, EPS. EPS is one of the most important information, most important measure of the performance of a company. Yes or no? Please communicate, right? You can ask, you can keep writing on the chat. Let me see. Yeah. So please communicate. That is okay. So that I am happy that you are in the discussion and we are having a common discussion. So EPS is one of the most important measure of the performance of the company. It is the most read and must read information in the financial statement of any company. Correct? Right? You may be an investor, you may be a banker, you may be an analyst, you may be a vendor or supplier. You may be associated with a particular company in whatever capacity, right? But EPS is such an information which is relevant for all of you, correct? So EPS is a tool to compare the performance of the different entities, right? In different entities in the same period, or the same entity in the different accounting period. Okay, so it helps the investor to know whether their investment in a company is earning the expected return for them. Yeah. Now let's proceed further. Objectives. There are two main objectives of the Ind AS. One is that to prescribe the principle for the determination and presentation of earning per share, that is the presentation in the financial statement. And the most important objective is to facilitate the performance comparison between the different entities, either in the same reporting period, or to facilitate the performance comparison for the same entities in different reporting period, right? Scope. The scope is very wide. There is absolutely no limitation on the scope. The scope is quite open. This Ind AS shall apply to all companies that have issued the ordinary shares, right? And you can understand the importance given by the Ind AS regime or by the standard setters that it is applicable, it has to be shown on the face of the financial statement, number one. It has to be shown on the face of the financial statement, both in case of standalone financial statement as well as the consolidated financial statement. Further, there are two types of EPS, basic EPS and diluted EPS, we all know. Both the basic EPS and the diluted EPS have to be shown both in the standalone as well as the consolidated financial statements. So now you can understand that it is such an important information that the standard setters have prescribed that it has to be readily available to the readers. Correct? It should not be given in the notes so that a common man, a common person who is not a financial expert should also be able to easily locate and read and use this important information in making his decision in relation to that company. The only and only special carving has been given in Indian accounting, international accounting standard, IAS 33. IAS 33 gives a choice to prescribe the EPS only in the consolidated financial statement, but there is no such choice in the Ind AS. Right now, you can see that how much importance the Indian accounting standard setters have given to this important information. The only and only little relaxation is given that in case of a discontinued operation, an entity shall disclose the basic and diluted EPS for the discontinued operation either in the statement of profit and loss account or in the notes. Otherwise, there is no choice. You have to very clearly state both standalone, both the basic as well as the diluted EPS, both on the face of the standalone financial statement as well as on the face of consolidated financial statement. Let's proceed further. Type of equity share, there is no brainer. We all know there are basically two types of equity shares. One is the ordinary shares, or that is the equity shares, right? It represents the residual interest after setting all claims and liability, including those for preference shares. Now, the point is that many of our colleagues have some kind of doubts. What is potential ordinary shares? So we will discuss it more in detail when we will discuss the diluted EPS. But right now, I am giving just a kind of a basic concept of the potential ordinary share. A potential ordinary share is a financial instrument or any contract that may entitle its holder to the equity shares of the company or the ordinary shares of the company, either on the happening or non-happening of a particular event or simply by passage of time. A few examples of the ordinary shares is the like preference shares, convertible, that is the convertible preference shares, options, warrants, right? So these are all what are the examples of the potential ordinary shares, correct? काजू दो काजू दो आपने ठीक. So that is the basically concept of the potential ordinary shares. Now, measurement of the EPS. Friends, measurement of EPS is the most important aspect. And if we say that Ind AS 33 is a measurement standard, that will not be that will be correct to say. So measurement, how the EPS is to be measured, that is right in front of your screen. Earnings available to equity shareholders of parent company divided by weighted average number of equity shares of parent company. And if you see, I have highlighted the parent company in the numerator as well as in the denominator. So what is its significance is that these two words have been added in the definition of EPS, right? In the Ind AS 33 only. These were not there in the AS regime, AS 20. And this, right? And these words have been added to the definition to make it more clear, this is the more perfect, right? So that there is no ambiguity or doubt, correct? So what is EPS? Earnings available to the equity shareholders of parent company divided by weighted average number of equity shares of parent company. Earlier in the AS regime, there were a couple of doubts the people used to have, right? Because of the word parent company were not there, but that has now been sorted out, and it's very clearly all doubts have been completely settled. That only and only the for calculation of EPS, weighted average number of equity shares of the parent company has to be taken. Now let's see we understand both the numerator and the denominator part separately to understand the measurement of the EPS, basically basic EPS. So first we take the numerator, that is earning available to the equity shareholders of parent company. Now, what is earning available to equity shareholders? You know that earnings available to equity shareholder will be PAT, profit after tax, minus preference dividend, less dividend distribution on preference dividend, right? This were earlier before up to the financial year 2021, but now from financial year 2021, dividend distribution, preference dividend is not taxable in the hands of the company. So it is not applicable after that. And that will be, so profit after tax minus preference dividend will be the earnings available to equity shareholders. Now, friend, there is an interesting point comes in here. What about the equity dividend? It is very clear to all of us that the preference dividend will be deducted from the PAT to calculate the earnings EPS. But what about the equity dividend? Do we need to deduct the equity dividend also, right, to calculate the EPS? Right, the answer is no, because, right, the answer we are calculating the EPS if we deduct the equity dividend also in the calculation of EPS, that will be RPS, retention per share, correct? That will not be EPS. So equity dividend will not be deducted from the profit after tax, but preference dividend has to be deducted for the calculation of EPS. Any question up to here? Right? Most welcome to ask. Right? Okay. And next is the weighted average number of shares. Now, the weighted average number of shares, correct, shall be the how to calculate. I will explain with the help of a simple case study that is there in front of your screen. On the left-hand side of your screen, the share capital register of a company is given. Basically, if you see, this is the typical sample of a share capital register of a company, right? Let's see that on 1st of April 2024, X Limited has an opening balance of equity shares 1 lakh. On 1st of June 2024, X Limited issued further 75,000 equity shares. On 30th November 2024, X Limited convert the convertible preference shares into equity. What is that? Just now we have discussed the potential equity shares, right? So now this potential equity shares were the convertible preference share. Now it has been converted into the actual ordinary shares, 50,000. And on 31st January 2025, the company X Limited bought back the 25,000 of its own shares. Yeah, just give me a minute. Yes. Yeah. So on 31st January 2025, company bought back 25,000 of its shares. And then on 31st March 2025, the closing balance of the outstanding equity shares were 2 lakhs. Now, how to calculate the weighted average number of shares in this case? Now, come to the right side of your screen. On 1st of April 2024, how many shares were there with the company X Limited? 1 lakh. Now, friends, tell me how many months or how many days these 1 lakh shares have supported the company X Limited before there is a change in the number of equity shares. So the next change in shareholding happened on 1st of June, correct? So from 1st April to 1st of June, how many months? 2 months, April and May. So this 1 lakh shares have supported the company for 2 months, right? So that let's give the weights. The weights shall be 2 by 12, 2 months out of the 12 months, correct? So the weighted average number of these 1 lakh shares will be 16,607 shares. Now, come back to 1st of June. On 1st of June, now the company has issued another 75,000 share. Yes or no? Correct. So the total number of shares becomes 1,75,000. Now this 1,75,000 shares have supported the company for how many months before there is a next change in the shareholding, right? June, July, August, September, October, November, 6 months. So the weights will be 6 by 12. So let's apply the weights 1 lakh to 1,75,000 shares into 6 by 12. That's give the 87,500 will be the weighted average number of shares. Then on 31st November, 30th November, there will be company has converted the 50,000 convertible preference shares into the equity shares. So the total number of shares become how much? Is 2,25,000, and is 2,25,000 shares have supported the company for how many months before the next change? And the next change happened on 31st January. So these 2,25,000 shares have supported the company for 2 months. Then the weight shall be 2 by 12. Then 2,25,000 shares will be multiplied by the weights 2 by 12 to give 37,500 is the weighted average number of shares. And then on 31st January, the company brought back 25,000 shares. So that number of shares will go down from 2,25,000 to 2 lakh. And these 2 lakh shares have supported the company for how many months, right? Before 31st March, 2 by 12 to give the weighted average number of equity shares, 33,333. Now, if we add all this weighted average number of shares, that will be 1,75,000. So even though the closing balance of equity shares at the end of the financial year was uh, uh, were 2 lakhs, but the weighted average number of shares would be 1,75,000. So that's the simplest and the easiest method, friends, to calculate the weighted average number of shares. The different experts have suggested some other method, but I particularly advise this is the best method. And why? You can see the image. It is very easy to follow, and also it's a self check. You can immediately say whether there is any error. So now see 2 plus 6, 8 plus 2, 10 plus 12, 12. So the 12, the weights have been correctly allotted. So 12 out of 12. So this is a very easy and simple to follow method, and I recommend this method to be followed to calculate the weighted average number of equity shares. So now, friends, we have understood the definition very clearly. So we have understand the numerator part, what is the earnings available to the equity shareholders of the parent company, how it is to be calculated, what is to be included and what is to be excluded. And now we also understand how to calculate the weighted average number of equity shares of the parent company. So let's proceed further. Okay. Now, let us understand how to calculate the weighted average number of equity shares in some special cases. One by one. First, how to calculate the weights, right, in case the shares are issued in exchange of cash, right? If the shares are issued in exchange of cash, then whether the weight should be calculated or considered from the date of cash receivable or from the date of cash received. Tell me, friends, right? Any idea? So, in case of shares issued in exchange of cash, the weight should be considered from the date of cash receivable. I will explain this with the help of a simple example. Now, for example, X Limited has issued equity shares of rupees 10 each on 1st of January 2025 and called rupees 5 per share to be paid by 15th of March. Now, I am taking you friends into your school days, right? You remember when we were making this is the learning, the general entries for the share transactions, limited company. So we were doing all this thing. So it's a very basic thing. Now, in this case, what will be the entry? What will be the entry on 1st January, right? Share first call account debit to share capital. Correct. The company has issued equity shares of rupees 10 each, on which it has made a first call of rupees 5 on 1st January, and the call has to be paid by 15th March. So on the 1st January, the company will pass an entry, share first call account debit to share capital account. And now on 15th of February, the amount of first call received. Now you have made the first call, paid the first call on either on 15th of February or on 15th of March, correct? And at the time of receiving of the call money, what entry company will make? Bank account debit to share capital account, correct? But can you see on which date on the this is the share capital account is created? 1st of January, correct? So that is, in case the shares are issued for cash in exchange of cash, that the weight shall be considered from the date of cash receivable, because after that it's only a cash flow. This is not from the date of cash received, is not important. Another logic, right? What is our fundamental accounting assumption? What are our three basic fundamental accounting assumptions? Correct? Accrual, going concern, and consistency. We prepare our accounts. We all know the first sentence in the accounting policy, the accounts has been prepared on accrual basis. Correct? Right. So, and in accrual basis, when the right to receive, correct, right to issue the shares is what? Is on the date of cash receivable. Correct? So, both way I have explained to you. You can understand and remember whatever way you want. So, that's the point. First special case. Second special case is on conversion of a financial instrument that we have just now seen in our recent example. So if the shares are issued on the conversion of a financial instrument, then the weight shall be calculated, considered from the date of conversion. Now, third is that if the shares are issued, right, for settlement of a liability, right, in settlement of a liability. So again, from the same thing, accrual based concept, the weight shall be considered from the due date of settlement, not from the date of actual settlement. Correct? For example, delayed settlement of loan by issue of shares. Correct? You have issued, given the money to a company. Company has promised you that it will return your money on 30th September. Right? The company failed to return your money on 30th September. It given you time till 31st October. On 31st October also it failed to issue. Now company says, I do not have any money. Right. So I am issuing you the shares. Correct. So the weight shall be considered, right, to calculate the weighted average number from the date of the due date of settlement. right? That is from 30th September, not from the date of actual issue, actual settlement, correct? Then next special case is amalgamation in the nature of merger. Okay. In case of amalgamation, in the case of merger, and amalgamation in case of purchase, right? Amalgamation in the nature of merger is what? Correct? Is the uh, uh, in AS earlier standard accounting standard. Amalgamation in the nature of purchase is that is the AS 40. Okay. So amalgamation in the nature of merger. In case there is amalgamation in the nature of merger, right? Okay, the weight shall be considered from the beginning of the period, right, in which the amalgamation happened, from the day one of the financial year. And what is the logic? Because in case of amalgamation, the new shareholders, the combined shareholders of the new company are entitled to the combined reserves and surplus of the amalgamated new company since beginning. Correct? Right? So they are entitled to the reserves and surplus of the past profits as well as from the new future profits. But in case of amalgamation in the nature of purchase, the acquirer is entitled to the only to the post-acquisition reserves and surplus of the acquiree. Correct? If one company acquired another company, correct, the acquirer company will be entitled to the profits or reserves and surplus of the acquiring company only from the date of purchase. Correct? And in case of bonus shares, there is, I will explain with the full example in detail in the coming slides. But here I am giving you a small concept is that, so to clarify the concept. In case of bonus share, tell me whether there is any change in the reserves and surplus of the company, whether there is any change in the earnings available to the shareholders. No, only the number of shares increase. So in case of bonus shares, the weight shall also be considered right from the day one of the accounting period, correct? And because there is no change in the shareholder funds. I will explain it in detail when we discuss the practical case study on bonus share. But right now we have learned that in case of bonus share, the weight shall be considered from the day one of the accounting period, financial year, not from the date of actual issuance of bonus shares. And lastly, in lieu of interest on principal, that in the shares are issued in lieu of interest on principal, right? So the day weight shall be considered from the date on which interest ceases to accrue, right? So up to these 7 special cases, my friends, if you have any doubt, please do not hesitate, ask, right? So I'm waiting for a few seconds. Any doubt anybody have, you can please ask me, right? Any doubt? You can write on the chat box your name and then can ask, right? Okay. Yeah. So I'm taking it further. We are proceeding further. Now, with this, we have completed everything about the basic EPS. Now we come to the second part, second type of EPS, which is diluted EPS. Now, for calculating the diluted EPS, an entity shall adjust the profit and loss attributable to the ordinary equity shares of the parent company and the weighted average number of shares outstanding for the effects of all dilutive potential ordinary shares. That's the standard language. I am giving you very simple understanding in very simple words. What is the common meaning of dilutive, right? What is the basic dictionary meaning of dilutive. So the dilutive means reduction in the value, right? Correct. So the diluted EPS means reduction in the EPS. Very simple. So diluted EPS means what? Reduction in the EPS and due to the conversion of, due to the existence and conversions of potential ordinary shares. Correct. So what is EPS? Is the diluted EPS reduction in the EPS due to conversion of the potential ordinary share, right, into the actual ordinary share. So what is that? What is the effect and why it is so? Now see, what is the definition of EPS? Correct. Earnings available to equity shareholders of the parent company, right? And divided by weighted average number of equity shares of the parent company. Now, what happens? Can you visualize very clearly? If the potential ordinary share is the company has the convertible preference share or convertible bonds or the share options or warrants. Now, if they are converted into the ordinary shares, what will be the effect? The number of shares will become more, right? There will be increase in the number of shares. And if there is no corresponding increase in the earnings of the company, right, then what will happen? What will happen? What will happen is that there will be a reduction in the EPS. And this reduction in the EPS is nothing but the diluted EPS. Now I will take you through this concept with the help of a simple case study. Right? Please note down this case study. A Limited, right? For 24-25, A Limited income before tax was 13 lakhs, tax rate 30%. Company have the 6% debenture of 10 each, right? 1 lakh debenture, out of which 50,000 are convertible in 2028, right? And the balance 50,000 shares are not non-convertible. Okay. So this is what? This is nothing but the company has the convertible debentures, right? So that is what is the convertible. That is what is the convertible. The potential ordinary shares, right? Out of which 50,000 are convertible in 2038 and balance 50,000 are non-convertible. Okay. So each debenture is convertible into one ordinary share of ₹10 each. On 1st of April, 2024, the opening balance their company was having an opening balance of 1 lakh equity share. Please calculate the basic and diluted EPS for the financial year 24-25. Now let's see how to calculate. Now first, we will calculate the basic EPS. The company has a profit before tax 13 lakh, right? And there is a tax rate of 30%. So 30%, 3,90,000. So the profit available to the equity shareholder is the profit after tax, 9,10,000. The company has an equity shares of rupees 1 lakh equity shares, right? So now you see these 1 lakh shares have supported the company for the entire year. There is no change in the shareholding in the entire year. So the weighted average weights will be what? 12 by 12. So the weighted average number of equity share remain the same, 1 lakh, and the basic EPS will be 9,10,000 divided by 1 lakh rupees, 9 rupees 10 paisa. Okay. The company has the how to calculate the diluted EPS. Now, I am giving you friends the golden rule, right? You may note down. So this golden rule, if you remember, you will never have any problem in understanding or quickly calculating the diluted EPS. What is the golden rule is that we assume the maximum possible dilution, right, on the first day of the financial year. What is the rule is that maximum possible dilution on the this is on the first day of the reporting period. Now, in this case, if we assume, right, the maximum possible dilution. Now, see, friends, here you need to be very careful. Here we are assuming, please note down my word. Here we are assuming that we are not actually converting, correct? You see, this is that we have already told the actual conversion of debenture will happen in when? 2028. But right now, for 2025, for calculation of EPS on 31st March 2025, we are assuming the dilution, right? So in the year 24-25, and we are assuming the dilution. So we the rule is, golden rule is, assume the maximum possible dilution. 1 lakh, what is the maximum possible dilution? We have maximum 50,000 debentures are convertible. So we assume all these 50,000 debentures, right, were converted into the potential share when on the first day of the reporting period, that is 24-25, that is on 1st April 2024. Now, friends, what will be the effect? If those 50,000 share debentures are converted to equity shares on the day one, first day of the reporting period, 24-25 financial year, there the company will not have to pay any interest. Correct? Yes or no? The company will pay the interest only when the debentures are there. Debentures are outstanding for the entire accounting year, 24-25. Now, if the company has converted all the debentures have converted into equity share on the 1st of April of 2024, there will not be any liability to pay the interest. Correct? There will be saving of the interest due to the dilution of 50,000 debentures on the day one of the accounting period. So 6% into 50,000 shares, 6%, what will be the interest? Saving 30,000. Okay. So the revised PBT will be 13,30,000, and the revised taxation will be 30% is 3,99,000, and the revised earnings available to equity shareholders will be 9,31,000. Right. Now, let's come to the calculation of weighted average number of equity shares. Now, similarly, as here also, the same rule apply. If we assume all the 50,000 convertible equity shares on the day one of the financial year, then that the number of shares will be how much? On 1st of April 2024, 1,50,000. And this 1,50,000 shares have supported the company, friends, for the entire year. So the weights will be 12/12, and the weighted average number of equity shares will be 1,50,000. And if we divide the earnings available, profits available to the equity shareholders by the weighted average number of shares, that we give the EPS is 6.21, 6 rupees 21 paisa. And the dilution and this reduction, this dilution of EPS from 9 rupees 10 paisa to 6 rupees 21 paisa is nothing but the diluted EPS. Correct? Now, what is the interpretation? The company does not have, this is the company earnings does not seems to be increase, right, to compensate the increase in the number of equity share. Earnings of the company, so the earnings of the company will go down from 9 rupees 10 paisa to 6 rupees 21 paisa, right, in future, when these potential equity share, in this case debentures, will be actual. Be careful that diluted EPS caution us or the any reader of the financial statement, anybody who wants to deal with the company, that please do not take the decision due to the higher EPS in the current year, right? If the company has a good amount of potential equity shares, right? Good amount of a potential financial instrument, right? Which will be convertible into equity shares in future. So please take the effect of the same also. Please consider the diluted EPS, and because the diluted EPS says the reduction in the EPS due to conversion of potential ordinary shares, right? That EPS is very much important, that it says then how much and how much decrease in the EPS may be there, right? When these put all these uh, potential ordinary shares will actually convert into, correct? So this is the dilutory 33, right? So not much difference is there. So only these two differences. There is absolutely no other difference. With this, we have come to the. I have said that I will explain how to calculate the EPS in case of bonus share, right? With the help of a detailed study. Yeah, just give me a second. Yes, friends. We'll have some water. So please note down this example so that to understand how to calculate the EPS in case of bonus shares. The share capital of X Limited, share capital account of X Limited is given below. Please calculate the weighted average number of shares, right? For calculation of basic EPS on 31st December 2024. Yeah. On 1st of January, the opening balance for 10 lakh equity share. On 31st March 2024, the new equity shares issued at fair value, 2 lakh shares. Again, on 31st June, the company issued bonus share. Here, now it's a bonus share question. Company issued the bonus share at the rate of 1 share for every 4 share. So what is the bonus share ratio, right? 1 share for every 4 share. That is 1:4 is the bonus share ratio. On 30th November, 30th September, the company again issued 250,000 shares. So let's see how to calculate the weighted average bonus shares, right? Weighted average number of shares for calculation of EPS in case there are bonus shares. Now, on 1st January 2024, the company shares how much shares, friends? 10 lakh shares. Now tell me whether these 10 lakh shares are entitled to bonus shares. Yes or no? Correct? Yes. Right? This is any share issued before the date of bonus share are entitled to bonus shares. There is no brainer in this. So there is 10 lakh shares are entitled to bonus shares. My next question is how much bonus shares? Right? 1:4. Okay. So on this 10 lakh shares are entitled to 250,000 shares. That is correct. 250,000 shares, and the total. So these shares along with its bonus content, correct? The total number of shares will be how much? 12,50,000 shares. So these 12,50,000 shares have supported the company standalone basis for how many months? Correct? For 3 months before there is any change in the shareholding. So the weights will be 3 by 12. So this 12 lakh for calculating the weighted average number of equity shares on these 12 lakh 50,000 share will be 3 lakh 12,500 shares. Now on 31st March, the company again issued the 2 lakh shares, right? These tell me, these 2 lakh shares are entitled to bonus shares, yes or no? 100% yes, because it has also issued before the date of bonus shares. So these 2 lakh shares are also entitled to bonus shares, yes or no? Correct. How many bonus shares? 1:4, 50,000 shares. So this 2 lakh shares will be entitled to 50,000 shares. That is total number of shares will be 250 lakhs. Plus, on that date, the earlier shares to 12 lakh 50,000 shares are also there. So on 31st of March, what will be the total number of shares? 12 lakh 50,000 shares, right? And then 2 lakh 50,000 shares. That is basically 15 lakh shares. And these 15 lakh shares have supported the company for how many months? That is the important point. Please check. I am stopping for a minute so that you can apply your minds. Right? So I told you, we have already learned that actual date of bonus share is not important, correct? Will not considered in the calculation of EPS. So in case of bonus shares, the weight shall be considered from the day one of the reporting period of the financial year, correct? So nothing will happen on these 30th June. So the next change of shareholding will be on 30th September. So this 50 lakh shares have supported the company till there is a change, next change in the shareholding numbers is 6 months from May to September, correct? The weight shall be 6 by 12 into 15 lakh, the 7 lakh 50,000 will be the weighted average number of shares. And on 30th September 2024, the company again issued 2 lakh 50,000 shares. So the total number of shares become 15 lakh plus 2 lakh 50,000, 17 lakh 50,000 shares. And these 17 lakh 50,000 shares have supported the company for how many months? 3 months, right? Before 31st March, so that 31st December, rather. So that's 12 lakh, 17 lakh 50,000 shares will be divided by 3 by 12, and the weight shall be 4,37,500. And if we add that all the total weighted to make the total of all weighted average number of shares, that will give us 50 lakh is the weighted average number of shares. And if we divide these earnings available to equity shareholders with this 15 lakh shares, that will give us the EPS in case of bonus shares. That is how the bonus shares EPS for bonus shares have to be calculated, right? And with this, we have come to the last part of this session, is the restatement of EPS. Okay. So now, friends, take an example. A company is having on 10 lakh profit available to equity shareholder, that is PAT minus preference dividend was 10 lakh for the year 2023. And the number of equity shares were 1 lakh. So the basic EPS for 2023 was rupees 10. Now in 2024, the company issued the bonus shares in the ratio of 1:1, right? So what will be the effect? The share number of shares will become 2 lakh, but the earning of the company does not change. The earning of the company remains the same, is 10 lakh. So what will be the EPS? What will be the EPS? 5. Now you see, for a common person, a layman, this will be a great disaster, right? He will not able to understand that there is no change in the earnings, his earning, right? Total earning. He will simply say, oh my God, what happened to this company? Suddenly within 1 year, right? There is a big 50% decrease in the profit, and that the EPS reduced from 10 to 5. So to avoid this confusion and this misleading to the users, correct? So it is the standard says that in case of if the number of bonus shares or outstanding increase as a result of capitalization, bonus share or share split, or decrease as a result of reverse share split, the basic and diluted EPS shall be restated for making the meaningful comparison with the previous years. Correct? Now, in this case, what happens is that what will happen is that there will be a restatement of the EPS for making the comparison, so that that there is no confusion in the to the shareholders. So the 2023 EPS will also be restated, right? So that there is no change in the EPS. So that is for making the logical comparison, correct? So friends, with this, I think the time is over. So I am now stopping for taking the various questions. So this is all about the Ind AS 33. I explained all the key concept of Ind AS 33. If you have any question, I will be most happy to answer. The floor is open. You can ask as many as questions. Satyam, you
Yes,
have
sir.
any question?
No question, sir.
Okay, shall we take it as no questions is pending?
No question in chat box, sir.
Yeah. So friends, thank you very much. I hope you enjoyed the session, and this session will help you in understanding the Ind AS 33 in much better way. And my sharing you with my
Manish bhai,
contacts.
can you share your PPT also so that members can avail the benefit if possible?
Yes, yes, I will share.
Otherwise you can share your contact detail also.
Yes,
So
yes,
that
I am
we
sharing
can-
my yeah, I am sharing my contact details, right?
Okay.
So that in case in anybody have any doubt in future, right? They are most welcome to ask me. I am sharing my contact number. This is my mobile number, right? And
Yes.
I am sharing you my email also. Just a minute. Okay. So I will give my email ID also here.
So thank you, Manish bhai and Narayan Chaturvedi ji for giving this valuable input to our members. We all are thankful to all of you for your time. Even today we have started the celebration of Diwali, so this is very important time, and pray all to God to give peace and prosperity to all our members and our faculties. So happy Diwali to all of you. Thank you very much. Thank you. Thank you, sir.
Thank you, Chavlaji. Thank you
Thank
all.
you, sir.
Yeah. And happy Diwali to all.
Thank you, sir. Thank you.
Thank you, sir.
Okay.
Happy Diwali.
Okay. Thank you.
Thank you.